From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
You're listening to the Macrocast, part of the Penta group of podcasts, along with Markets Policy Partners, our friends John Fagan and Brendan Walsh. I'm Tony Fratto. We also have John Dick with us today, as we do at least monthly, from Civic Science to talk about how the consumers are doing, how people are thinking about things. That we're getting into that really important part of the retail market, which we always like to hear from John, looking ahead to the holiday shopping seasons. I think it's not even one season; it's like multiple micro seasons in a lot of ways. So we definitely want to do that. We got some important news this week on backward looking read on the economy, on GDP, which had some interesting takes on where people think things are. I would just call it just generally sort of steady, steady as she goes, confirming or eliminating some of the worst fears on where people thought that growth is right now. Not at all completely taking them away, but it doesn't look like the bottom is falling out of the U.S. economy. We got prices today. We got some information on the employment cost index, core PCE. So we're going to dive into all of those things. And I guess we can't mark this date without noting that now Elon Musk owns Twitter also. So that one long saga is over. A new long saga in the Twitter world is about to begin. So let's get into it, guys. Let's start with GDP. It was a lot. The initial reading on GDP, the way it's been reported and the way it was understood is the way I said, right? It doesn't look like the bottom's falling out. Not obviously very slow growth. But doesn't look like it was confirming a present recession. John, Brendan, what do you guys think?
Yeah, definitely. And I think also because when coming out of the pandemic, we contracted so much, so then we grew a ton. So we kind of had to normalize a little bit. So I think some of the negative growth rates were really just weird quarter over quarter. And I think the reality is we're growing somewhere between 1% to 2%, on an annual basis. We have to be very worried, though, about Phillies winning the World Series, because every time they win a World Series, we go into a recession.
That I think is Philly won't be in a recession, though. You won't be able to get a cheesesteak in that town.
Philly will not be in a recession. But
the GDP report really had a little something for everybody, right? If you were worried about growth, you can kind of point to the real final sales to domestic purchasers, which was 0.5%, which is pretty flimsy. Yep. And you can say, well, the big growth was in stuff that's not really going to last, like net trade and inventories, government spending, that sort of stuff. And then of course the optimistic crowd would counter with the GDP price index, which is now we're all like forensic scientists for every little nugget of data that speaks to inflation, now that the Fed is cherry picking any inflation data. And so this, which, under normal circumstances doesn't get a lot of play, really did get a lot of attention. And it was considerably better than expected. It was 4.1% versus a 5.3% consensus and 9% the prior quarter. And so, that was part of the positive and sort of Goldilocks reaction to this. We saw on the day a really significant rally in treasuries on the back of this, which wouldn't necessarily follow with a stronger than expected GDP. You'd expect the treasury yield curve to steepen, but you wouldn't expect a big rally across the curve. But that's what we got, and I think that was speaking to the overriding focus on inflation, which has been with us for a while now, obviously.
Yeah, and today we got the employment cost index, which was when Powell kind of made his hawkish pivot. That was one of the data points that he cited as troubling. And today it came in not particularly troubling.
And what used to be the Fed's preferred metric of inflation expectations, the core PCE price index, that came in, I guess, just on the screws with expectations. So nothing untoward there. It was a little bit lower than the prior month. Not mission accomplished banner hanging behind you at the Fed or anything, but I guess not as scary or upside concerning as we've seen in some of those over the summer inflation readings.
As we've talked about, so much of the readings on the inflation, the CPI, is the housing component, and all of the housing data we've gotten in the last week has been horrifying.
Yeah, pretty dramatic. Which, look, I mean, if we were going to say we're going to do significant rate rises, successive 75 basis point increases in the policy rate, where would that show up first and deepest? Housing, and that's exactly what we're seeing. So no one should be surprised by that. John, Dick, what are we seeing from the way consumers are thinking about things?
Well, I mean, it's like everything else. It's kind of a mixed bag, almost like this sort of tale of two stories. You've got our economic sentiment index climbed this week, which I sound like surprised by it. Maybe I shouldn't be. But I mean, it's the first upward reading we've had since I think like late August or so. But underneath that are two sort of, again, the two stories. First, I mean, the big story, I think, at least right now, is how resilient the consumer still is from a personal finance and spending standpoint. When we ask them about the state of their personal finances, they still feel pretty good. That's manifesting itself in continued strong consumer spending. Bank of America reported that deposits grew 1%, credit card spending's up, which is good and bad. Certainly good for retailers, I guess, going into the holidays. American Express customer spending jumped 21% year over year. Now that tends to be a bit more of the upper end of the income spectrum, but that's driving a lot of commerce and retail. So we've got a lot of Americans saying that they're living paycheck to paycheck. That number has climbed good 6 percentage points from this time last year, but it really feels like the people in that remaining 37% who aren't living paycheck to paycheck are outspending the difference, as it were. So continue to be, somewhat optimistic, not bearish or necessarily bullish about holiday retail, but think it should be good to slightly up just in total dollar spend.
John, do you have a sense? I wish I knew the answer to this. I hope you do, and if not, maybe it's something we talk about next week, or if you could just send it to us. Is what is the normal rate for the number of people, sort of the pre-COVID rate of people living paycheck to paycheck?
I was always kind of around a half. At least report that, right?
Yeah.
And it's a tricky question to ask because it kind of means different things to different people, quite frankly, right? And that depends on sort of what stage are you so-called house poor versus, right, like legitimately worrying about getting your bills paid before they shut your lights off. But it always sort of hovered around 50% or so. This time last year, we still had a larger percentage of Americans who said they were better off financially than they were before the pandemic than people who said they were worse off. And that has sort of flipped a bit, but it's staying relatively steady from where we saw it, like even kind of really flipped sort of like March, April of last year.
It's one of those things where, all the banks reported and they talked about, the relative health of the consumer and the relative healthy balance sheets of their customers. They still see them, for the most part, still spending. And there's this view, which is the conundrum for central banks in a way, is that, they're trying to pressure consumers to do less economic activity. But consumers got into a pretty good habit of doing a lot of economic activity. And as long as they still have money in their savings accounts and increased wages, you're diminishing the likelihood that they're going to, slow down their economic activity.
But I think that does sort of speak to the two parts of the ESI, right? So the other positive indicator this week is that confidence in new jobs rose a full point again after kind of sort of softening there for a little bit. Lots of the news that we're hearing about layoffs and hiring freezes in the market tend to be in places like big tech, which get headlines, but don't necessarily represent the totality of the U.S. population. The two numbers that fell, neither of which I think should be surprising under the interest rate circumstances, of course, confidence in the housing market fell, and probably will continue to fall for the foreseeable future. And then the other one is we ask specifically about people making major purchases like a car, large home appliance, and that confidence in those things fell as well. Why? Because there's generally financing required behind those kinds of things, and people are either concerned about or spooked about future interest rate implications. So yeah, I mean, it's all just sort of and I think some of these levers that people are pulling to sort of manage our way through this seem to be having an unsurprising impact on that. But yeah, it has not yet seemed to have hit again, at least the entirety of the consumer population. A couple interesting trends we're seeing going into actual holiday retail is there's sort of like a renaissance of in-store shopping. We're seeing like back to like, certainly pre-COVID levels, but almost like, would have been surprising going from 2019 to 2020 if the COVID had never happened to see this bit of an uptick. It's being driven a lot by younger consumers who actually like want to go back into a physical store, maybe troll the mall with their
malls are back.
Yeah, their flannel t-shirt, their flannels wrapped around their waist and their Vans, circa 90s. But what's interesting about it is like when you sort of study why that people are going back into physical stores, it's something about the experience of it, right? It's not that they're deal seeking, right? The deal seekers are generally, they're finding those deals on the internet. The internet's a deflationary retail tool. And it's almost as if like this notion of like revenge travel you hear about, or revenge experience spending is like playing itself into the store space going into the holidays. Like I love
that idea. Yeah. But by the way, John, I mean, and as John Fagan and Brendan also, because we saw Amazon report, Apple and Amazon reporting is it. So you have this, the tech route going on, right? Which is like, there's a, shares of tech companies just getting demolished. Meta / Facebook at the top of that list, especially after this week. Maybe not the maybe Snapchat, but the most prominent, most important was Meta. But Amazon, that's interesting, right? Because Amazon, its outlook was not as strong. And you would think that they would be the firm that suffers most from return to walk-in, brick and mortar shopping, right?
It was also a combination of what you mentioned earlier, that they ramped up hiring so much during COVID to meet all that demand that they kind of overdid it, and now things are normalizing it a little bit.
Anything else? By the way, anything else that you guys saw from earnings this week that for sort of more clues on where things are?
Yeah, I think Facebook Meta was entirely self-inflicted. That Zuckerberg is obsessed with the metaverse and spending a huge amount of money on it. But I think that Amazon, and Apple too, do have macro implications that they're doing fine, but people are just buying a little less.
Well, I think in our world, watching the consumer, the one that we paid closest attention to was Google, and you're beginning to see the real effects of people pulling back on some marketing and advertising spend. Yep. That was and how how prophylactic that is depends on how cynical you are, but it like a lot of advertisers, because we work with a lot of these companies. They've been riding super high profits for a really long time, and they're probably better safe than sorry. And they're saying, look, if there are places where we can throttle back a bit, the easiest place to do that is in advertising. Yeah. And that's, of course, I think that's what really showed up in Google's numbers this week.
But is there any question? And I don't know the answer to this. I mean, there was a very, very strong shift for all the same reasons to digital advertising, and I do think that is sort of that's a structural shift that we're going to see going forward that's what we're going to be going forward for a long time. However, in the same way that there was like the shift to the interest in streamers and paying attention to subscriptions at Netflix and other places, and people forgetting about legacy TV, is there legacy advertising that shifting back to legacy advertising because there was sort of an over index during COVID to the digital space? Is that something that we should, that's a consideration?
We have to watch. I think it's, so much of that, so much of those big numbers happen during like the upfronts in May, right? And so like so much of the spending that's happening right now on like say television was locked in way earlier in the year. It'll be interesting to watch things like, Super Bowl spending going into January. That like what are the ad rates in the Super Bowl? That would be an indicator. There when we look at sort of like local advertising, that has been softened a bit. Part of it's because like so much more spending on political advertising has moved to the web and social. So it's not landing on like local TV stations the way it might have used to. Although if you spend 5 seconds on TV, you wouldn't believe that because it's, obnoxious. But there's not necessarily any sign. I mean, one of the big things that's going to drive probably a call it a correction in ad spending is going to be some of the continued coming of like regulation and digital advertising and privacy. We're not quite there yet, but that's going to be a boon for sort of like the open web and connected TV and the like. But that's not happening yet. If that spending shift is happening, it's not evident to us yet.
Well, we're definitely going to be keeping a closer eye on that going forward, because I think there is my gut says there is some misreading of consumers in some ways, and that will be, if you, depending on which part of the economy you look like you're looking at, interpret a drop with a shift. It's actually a shift and not a drop, and it's a drop in one area but a move to dollars in another area. And I do think that should be a lesson learned from COVID. And we should keep learning that lesson. Look for those shifts in spending, not just drops in spending.
I mean, we beat our heads against the wall with this all the time with our customers to stop looking at the top line numbers, because they mask so much nuance underneath it, right? They're up lines on a chart are amalgamations of lines going in different directions that happen to average out in that one,
Yeah.
Yeah, and we get in earnings season, the way that it comes out, you don't get the big box retailers until way late in earnings season. Yeah. And so we've got kind of one side of the story, right? We've got like the online and when Walmart, Target, Kohl's and the like come in later in earnings season, that's going to give us maybe, the fuller picture, the other side of the coin, I guess.
Well, look at here. I mean, just as maybe a leading indicator of that is like, look at McDonald's earnings. They killed it. And what I think like up 6+% or something, I forget the exact number, but that just says people are still eating out and spending money. They may just be shifting, right? They might be shifting down
and McDonald's
market.
Even said that within them, because they raised prices and they were able to do it, but they said that the people at the lower end didn't leave McDonald's. They just shifted what they bought at McDonald's to the cheaper options.
Dollar menu kinds of
exactly.
Which means you can see a lot of shifting to the Dollar Generals and the Family Dollars and the like. I mean, we've started to see that earlier in the year, this sort of just shift down market. Like I'm going to stretch my dollar further. I'm not going to not spend it.
No.
Yeah, and we were talking about the McDonald's staffing, the hiring. One of the interesting things, this was noted by someone I had dinner with last night. Essentially, they had real trouble hiring people during the pandemic, and they are not laying people off, but they're not, and even if things are strong, they're not really hiring people anyway. They've realized that they can get by with 2/3 of the labor force. That they automate, they work, people are just willing to wait longer in lines.
About 3 months ago, their trade industry said that they're no longer having staffing issues. They've found an equilibrium.
Amazing. Well, look, the people who have to interpret this the most to figure out what to do next from picking up these clues are the central banks right now. We've heard from a couple of them this week. All eyes are on the Fed going forward. Not so much for this next meeting, except for what kind of clues you get from this next meeting.
Exactly.
Right. For going forward. But we heard from ECB, we heard from Bank of Canada, which really surprised people. I think that the key word the key phrase that we heard, certainly that investors, love to hear right now, is substantial progress. Like the word substantial progress was used quite a bit. Canada surprising with only a 50 basis point increase, and signaling slowing. of increases. Same, the ECB went, Christine Lagarde went, 75 basis points. Sounded like, yes, they're going to, the work isn't done, but she said substantial progress quite a bit. So, I know there's debate as to whether to take it, she's letting her foot off the brake a little too early or not, but they have, real growth concerns in Europe. So what y'all's, what does this tell us about where the Fed is? I mean, there's so many implications for it, for, currencies. We saw, we saw euro fall back below parity. I think, we're paying attention to the pound also. How are you thinking about what this means for the Fed at this point?
We got signals over the last couple of weeks that the Fed at least is pondering thinking about this downshift or a step down or essentially a modulation. And our old friend and friend of the podcast, Nathan Sheets, was on Bloomberg yesterday. I thought he put it really well. He said the Fed has sort of boxed themselves in because they've created this syllogism that is, if they're serious about fighting inflation, they have to hike 75 basis points. And 75 basis points may be appropriate at the tightening cycle phase of the summer, where they were really getting going, felt behind the curve. But at some point, and roughly around now, one would think, that is an inappropriate quantum of tightening when you're getting into some significant economic and market uncertainty. There are obviously more balanced risks. These are not like a bunch of dovish central banks. The ECB has a very significant balance between hawks and doves. No one thinks the Bank of Canada is a dovish central bank. We did get the arch doves at the BOJ overnight, holding the line with yield curve control, and they're ultra accommodative. But put that to one side. The Reserve Bank of Australia has already stepped down. More and more are doing that, and the kind of commentary that we've been getting from the Fed. San Francisco Fed President Daly has been on the forefront of this. We've heard it from Chicago Fed President Evans, and we've heard Governor Brainerd talking about this as well. This sort of more balanced formulation. And the Wall Street Journal, well-sourced tweets a couple of weeks back about.
And BlackRock economists came out yesterday saying that they expect the moderation in future rate hikes to show up in the statement from the Fed next week.
Yeah, but the weird thing is, the Fed has shown this over sort of like the July to September time period, that sort of, the shift from balanced Fed to ultra hawkish Fed shows some sort of determination to, send a really tough message to the market. And just when everybody thinks they're going to pivot, that's the reason they're not going to pivot. And, that's the kind of, a little bit of, non-fundamentally based decision making that has sort of tripped up financial markets. It's really hard to take a look. I think that the other central banks have put it pretty well. Substantial progress has been made in tightening. Substantial progress has been made. Progress has been made on the inflation. The fight's not over, but you somehow have to figure out how to go from 75 to 50 without engineering a massive loosening in financial conditions. Well, the earnings season is here to help you, right?
Yeah.
If earnings season, if earnings were great and corporations were coming out and saying, things are fantastic and we've got great outlook and that sort of thing, well, you'd have a much more forceful rally potentially going into this pivot. Now you've got like the potential upside impetus for risk assets versus these pretty clearly deteriorating fundamentals, which I think takes some of the risk of this, big rally that the Fed seems to be terrified of stoking with a step down as coming in through this end of this year.
Hey guys, longtime listener, first time caller. Given all this, the mixed signals out there, and maybe we'll never know because it's too late. But is there possibility of how much we're just talking ourselves into all of this? I mean, given sort of how unprecedented the circumstances are. I mean, I just added the word transitory to my vocabulary about a year and a half ago, and that turned out not to be the right not to be right? Like, what makes us so certain everybody's right now? Like,
it's transitory in a, it's just everything's about time, or you need to like extend your
exactly.
a little bit.
Sure.
The transfer,
Sure.
The Great Depression was transitory too, right?
Yeah, right. Of course. I mean, it's all cyclical, but I mean, like at this point in time, I don't know, just sort of right now.
Look, John, we met, you and I built the ESI 11 years ago.
Yes.
Because we think sentiment matters. And I do think sentiment matters. And it does, the way people feel about things often, not always, but often influences their spending decisions. But we've seen in recent years divergence between the way people feel about things and what they actually do. And, and with healthy balance sheets, they may think, well, other people are going to have a tough time, but I seem to be still having a pretty good time. I do think in this case, I don't know if we're talking ourselves into recession. I do hear people talking about recessions off into the horizon. So talking about a recession in 2023, which a lot of respected people, the people who I really respect are, they saying these things. And I just say, well, there are things that you can do today to prevent a recession in 23. Maybe the things that you can't do, but it is far enough ahead that you should be able to do some things and moderate, like in the case of central banks, financial conditions are tight. That was the intention. They're definitely having an impact. We see it in the real economy in very, clear ways. They can moderate from that. And to me, the question is the timing of it and when they do it. And then how much confidence is it that the moderation will stick around for a while so that people will have, a little bit more, a sense of confidence about what the future looks like. Yeah.
And to just look at the outlook through the market lens alone, it's screaming recession. I mean, it couldn't be more clear. Like if the most dependable recession indicator is, of course, inversion of the Treasury yield curve, where short end rates are above longer end rates, and whatever part of the yield, even if you're like, look, you're giving yourself an easier 3-month, 10-year, that's inverted too.
Yeah.
It would be.
It has been for a long time.
It has been for a long time. It would, and stocks are down, like the NASDAQ is down 30%. This is very recessionary kind of. The dollar is at a 2-decade high, which is knocking the stuffing out of companies' earnings.
Why? I mean, we talked about inverted yield curve for a couple. Why is an inverted yield curve signal a recession?
Well, there's on one side, it reflects expectations that interest rates in the near term are going to roll over and fall, and that on a going forward basis. So the further out the curve you go, interest rates are seen trending downward, which suggests that this, the policy-driven front end of the Treasury yield curve, which really is very much like 2-year yields, are very much keyed into near-term Fed rate hike expectations or Fed rate expectations. The back end of the yield curve is much more about growth and inflation expectations over the medium to longer term. It's not 10, it's not 10 years out if you're looking at the 10-year. So that curve itself is showing you expectations are for the Fed to ease. And if you look at Fed fund futures, the expectation is indeed for the Fed to start cutting rates in the middle or toward the end of next year amid a recession. There's also the argument that an inverted yield curve can even cause a recession because it creates a dynamic in which banks are borrowing short and lending long. It's less profitable for them to make loans in that yield curve formulation, and so they pull back lending. And then, of course, it's the sentiment aspect. Everybody in financial markets, it's become pretty well known that that's a reflation signal, and they behave accordingly.
Yeah.
But Tony, one thing that, maybe the talking ourselves into a piece, I'm thinking a lot about it from the consumer, because we have definitely watched this happen with the ESI over the last 11 years, is it's in some ways almost now a bit of a lagging indicator in the following respect. Is when we dig a level beneath members and look at things like the party affiliation of our respondents, like Republicans right now have a significantly worse view of the economy than Democrats do. Part of that's always been true because sort of it's a function of the confidence they have in the people in power to steer the economy. But that has widened even more in the last year and a half. It feels like the economic news has been so heavily weaponized in the political sphere that, people are having economic news put in front of them that maybe they weren't quite digesting as much before. So, if consumers are told, oh my gosh, a recession is coming, that impacts their consumer confidence. The question is will it actually affect their spending behavior? And I guess we'll know that at the end of the holidays.
Indeed.
Yeah.
Were you surprised at all, guys, about just especially thinking about Europe and the ECB right now, about where ECB came out, given what the complex situation they're dealing with?
We've been taking the under on central bank rate hikes from here, and the ECB was in focus because of the fragility of, let's say, Italian bond markets, the peripheral bond market. They're much more difficult balance with the energy price increases, a much more stagflationary dynamic, less economic vibrancy to begin with. It's a real Pandora's box that they're grappling with over there, and so letting the Hawks have their day with 275 basis point hikes in a row, I think allows President Lagarde to do what she did, which is to basically take quantitative tightening, which is like future rate hikes, and like cover those with ambiguity, two-sided risk, data dependence, that sort of stuff, and take quantitative tightening and throw it further into the future, which was that the prospect of that was giving some heartburn to the peripheral bond markets and Italian, but particularly with the new Italian government saying a bunch of different things about how they're going to orient themselves to the fiscal policy and so forth. There was a lot of uncertainty there. And so it seems like she's, given the Hawks enough of what they want, and now she can begin to create this better balance and risk manage their tightening cycle. And that's really what it's about. It's about risk managing the tightening cycle, and doing things that are not going to thwart you. Because if you tighten too much and and if you start up quantitative tightening and upset the Italian bond market, then guess what? You have to stop tightening or increasingly have this Bank of England contradictory price monetary response where you're tightening with one hand and loosening with the other to try to keep things from sliding off. Very suboptimal. So I think that the Fed, hopefully is taking a lesson from this, that risk management at this stage of the tightening cycle is important. And if they can't communicate effectively with the market that going from 75 to 50 basis points is, not a loosening and isn't going to, create some sort of untoward loosening of financial conditions. If they can't communicate that, then maybe they should look in the mirror.
No, you're right. And I thought Lagarde's press conference was a masterclass in how to communicate that to the markets. And hopefully Powell was taking close notes.
Yeah, I thought she did a good job with it, truthfully.
Yeah, maybe they should consult with some communications experts.
Well, they could for maybe a week or two, guys. I think, as we've announced publicly earlier this week that I'll be leaving the Penta world, the Penta universe, to join Goldman Sachs, which means that
means that you actually will be the spokesman for the Fed, because that's what all Wall Street believes.
That's my news this week, that I'll be leaving to the firm I founded, and the place I love very much, but going to Goldman to be global head of corporate communications there. So I'm really excited about. It's a great opportunity and an incredible bank really looking forward to it. But bittersweet to be leaving both my firm but I'll be leaving this the Macrocast as well. And so that's sad. There'll be more to come on where it's going. It's not going away, if anybody's wondering. That's not in the cards at all. It's not dependent on me by any stretch.
Though you are irreplaceable, and we can't thank you enough for really for giving us the chance to do this podcast with you, which has been so much fun, and we've learned a lot and had some I hope some insightful discussions over the years. But congratulations on your new chapter. It's truly exciting, and the legacy that you built at Penta and the fantastic team. It really is just a testament to the hard work and the management capabilities that you brought to, when you started it, was it 2009, 2008, sailing into a hurricane, and you've really built something very special, and it really shows through in the people that you have at Penta. So congratulations, Tony.
Thanks, John. I appreciate it. Oh, go ahead, John Dick.
I said, I'm not crying. You're crying.
We'll do. I still have I think 2 shows left in me, so we'll have more to say. I'll say a final goodbye on my last show, but it has been, you guys know this, but just an enormous joy for me to do this podcast, and it's in some many weeks. The favorite part of my week was Friday morning, getting on with you guys to talk about what's going on in the world and the economy. And it's always been just, terrific discussion. So we'll do a couple more of these and then say our goodbyes. But to our listeners, thank you. Thank you very much. Really great. Have a great weekend. We'll be back next week with Jobs Day. So really big show next week. Thanks for joining the Macrocast.
On the first Friday of every month, Penta analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at pentagroup.co or on Twitter at PentaGRP. Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.